All right, today's stock is a stock that's trading really close or pretty much right at its 52-week low. And we like to look at stocks that are trading close to those lows just to see if there's some value there that we can grab, see if it's a great opportunity. Now, this thing about this stock, it is a very strong brand with a very strong dividend. So it has a lot of people who like to invest like me, very interested to take a look. So it is UPS, and let's dive right into it. So right now, UPS is trading at $109.95. After hours, 110. So $110. Today is March 25th. So we see that looks like there was a high here, and it's a downtrend ever since then. Pretty significant downtrend. I do like to look at technicals a little bit. So just looking at the technicals of it, we see that we have the 50-day moving average that crossed over the 200-day moving average. This is called the death cross. When that happens, when the 50-day crosses over the 200, and that happened at about $172. We're at 109 right now. So it looks like it's definitely a long-term downtrend. So it looks like it could fall some more, but we want to see if now may be a good time to start averaging into this stock, as we do expect it to go down some more. So we'll see. So looking at the stats of the company, we have a market cap of 93.1 billion, beta of 0.93, so a little less volatility than the market. PE ratio of 16, earnings per share of $6.75. Dividend, 5.6% dividend. That's a really strong dividend yield. So let's look at the revenues of the business. Now, first thing right off the bat, we see 4.6% growth for the past 5 years. That is normal for a very mature company. So that lets us know that they're not in a growth state. They're not in a high growth state. And this is a mature business. So we want to look and see and expect some mature numbers and margins. So 58.3 billion to 91 billion in 2024. We see that we had 100,000 as this high in 2022. What I like to look at is any years that are flat or negative. So we have 1 year negative and we have a flat year. So no growth from last year, practically no growth. And we had negative in 23. So we need to understand, is this a long-term trend where the company will be kind of flatlining or declining or not? So that's something we got to understand before we invest in this business. So looking at gross profit margins, we see there's a little bit all over the place, 46%, 9, 11. Then it's kind of been trending in the high single digits. Then we get to 13, 18, and 18. So margins look pretty solid over the past few years of almost 20%. Not consistent, always positive. And we have three negative years, 80%. -6 and -5% margins over the past 10 years. So what we don't like, even though revenue was flat, margins was less, 18.9 to 18. We don't like to see lower margins on minimal growth revenue. So that's not a good sign. So let's look at profitability. Let's see what we see. All right, so 2015, 4.8 billion, 2024, 5.7. So not a lot going on between these 2 years, pretty flat. We see that it came up. We had more than a few years of negative growth here. A crazy year of growth in 2021, and that's skewing this 144 average growth rate there. It's all because of that 1 year, because since then, negative. So profitability is there. It's positive, but it's not necessarily trending in the way that we want to see it. So yes, we know that they're a highly competitive industry when it comes to the United States Postal Service and FedEx. So we understand pricing pressure because customers can always choose a different option. So this does make sense for a mature company. It's not like it's a booming company they're dominating. They have lots of competition. So I think that makes sense. Not great, not horrible, but it does make sense. Free cash flow. We should see some similar trends to profit here. We have 1, 2, 3, 4, 5 years of negative growth. Again, another high in 2021. 3-year growth rate, negative 12%. So we got to keep an eye on that. 1 year of negative free cash flow in 2017. That can happen from time to time, being that it's 1 year in the past 10 years. With this type of company, as matured as it is, I wouldn't worry about it. So let's look at the balance sheet. How quickly can they pay off their debt? 2015, 11.7 billion in debt, up to 19.4. Cash flow is a little bit all over the place, but one good thing is they average 3 years to pay off their debt. So that is good leverage. We want the company to be 3 years or less. They're right at that 3 year mark for their average, for both the 3 and the 5 year average. So no complaints there. That's a good position for them to be in. Let's look at what we came to see, the dividend. So about a 5, almost 6% dividend yield right now, paying out about $6.56 on the year. And here's a key number here, the payout ratio, 86.7, almost 87% of their free cash flow is being paid out in a dividend. So this means this is not a dividend growth stock. This is a solid high yield stock. So if you see a payout ratio of over 75, definitely over 75%, you definitely want to see a higher yield. I would say high 2s, at least in the low 3%. Right now, they're trading not necessarily at a discount, but they're trading at a price where the dividend just happens to be a little bit higher. So this is not a good dividend growth stock, but it's a good dividend yield, dividend income stock. You invest in this if you want dividends now. So people who are older, who are looking for some income, this might be a good play right here. So that's the most important thing we want to see. A growth rate, pretty minimal, 6.61, 0.62. High here, 6.5, really high here, 49% growth rate here. Then 0.9, 5%. So moderate, a few high years, a few spikes, but I would expect that 0.62, 0.61 in the future. So as you see, they only added 1 cent this year and they added another cent this year. I would expect that because this company is not growing and the payout ratio is already pretty high. So this is not what you would look for when it comes to dividend growth, but still a solid dividend. So this is definitely more of an income stock, in my opinion. Now, shares outstanding. If you're going to make a lot of money with this stock, this is going to be where it's going to be. So right now we see that past few years from 2019 to 21, they were selling shares, increasing their shareholder count, and they've been aggressively paying it down over the past 3 years. I love to see it now. They have about $2.3 billion left on their 2.8 commitment that they made a few years back. They paid about 500 million in share buybacks this past year. So as we see this solid downtrend, so with 2.3 million left and they're paying about 500 million a year, we should see many years of the share count coming down. As the shares come down, their earnings per share increase. So there's going to be a lot of value added to the shareholders. So you have a 6% dividend yield, almost 6%, and they're going to be buying shares at a very high rate. Similar to what we saw with PayPal. This is going to be a lot of value to the shareholders here. So this would be the biggest draw for me to have interest in this stock, is for them to continue to buy back shares. And here's another thing I like about this stock. UPS has a very high spread of returns on capital compared to their cost of capital. So when I say returns on capital, I'm not necessarily talking about profit. When we talk profit margin, we say profit compared to revenue. We're saying profit compared to all the money you have to use for your business. So your debt and your equity, that is your capital. Return on capital, 18.5%. Cost of capital, how much does it cost for them to get that money? What's their interest on their debt plus the opportunity cost on the capital or the equity that's coming in? Here we go, 4.69. They have a spread of 13.8% value added. So pretty much every year for the past 5 years, they average about 14% of economic value added to the business as they continue their operations. So this means this company typically is in a safe position to continue going and not necessarily growing at a higher rate, because that's not where they are. But this again looks like a safe investment because of the spread here. So I love to see it. Now let's look at the valuation. Of course, we want to be conservative. We want to be mindful of the company that's not really growing. Now, their revenues haven't been growing a lot for the past few years, but their free cash flows have been growing. at a very high rate, but I'm being super conservative because I don't know if those revenues are going to continue to decline or stay flat. So I'm not going to estimate a very high growth rate. So 3% growth rate estimated for the next 5 years, a hurdle rate of 10%. Remember, their cost of capital is 4.6. So 10%, I think that's adds some a conservative approach there. So if I were to sell this stock in 5 years, I expect to sell it for at least 10 times the free cash flow amount. For reference, right now they're trading at about 15 times free cash flow. So a little bit over what I would consider a safe range for a mature company like this that might even be in the declining state. So I would say at least 10, given the dividend, I don't think this stock is going to drop very low. If that dividend starts getting to 7 and 8%, I think a lot of people are going to flood this stock and keep the price floating a little bit. With that said, I have the intrinsic value at $79. I believe the fair range is between 83 and 75. Right now, about 27% downside compared to the current stock price. I believe that the stock is going to continue to slide, and we should be able to grab it in that range between $75 and $83. If not, I wouldn't mind grabbing it at about 90, 95 if you don't believe it's going to come down this far. But keep an eye on it because that dividend is strong and I believe it's safe. Not going to grow a whole lot, but it's going to be there. Again, the value added for this stock is going to be, one, they have high returns on capital compared to their cost of capital. Two, they are buying back shares at a very high rate. Not as big as some of these other companies, but their share count isn't as high as those companies as well. So when it comes to the impact, I think here and PayPal are the two companies that I've seen recently, mature companies or more mature companies, but PayPal isn't in the same place as UPS. They still have some growth, but just not strong. But here, not a whole lot of growth that we're seeing, but with them buying back shares and paying that strong dividend, practically all of the free cash flow that they have is going to come back to the shareholder, adding value in some way. Again, dividend or buying back shares. So I believe that's the draw here. So hope you enjoyed this analysis. Let me know what you think in the comments, and I hope to see you in the next video.